Are you funding your HSA but then not using the money? There are some significant benefits to treating your HSA as another retirement account. I'm going to explain 3 of them, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. So the HSA plan, if you've got an HSA qualifying or eligible high deductible health plan, then you can contribute to an HSA, and the immediate benefits of doing so are obvious. But some of the later benefits that you would see later in life, they're not as obvious, and I'm gonna showcase those today on this video. But the immediate benefits are pretty astounding. The HSA is really unlike any other tool in the tax code, and that is you can contribute into your HSA pre-tax, so it's pre-tax money going in, saves you federal and state taxes, and then also if you contribute right out of your paycheck, it saves you FICA taxes as well. So I don't know of anything else that is pre-tax and pre-FICA going into an account that, again, is not use it or lose it. I just had this conversation recently as well where, I thought the HSA was an account that if you don't use it, it's gone. No, it's your money. It's not use it or lose it. It's your money, okay? But then the HSA plan, all of the activity, so the interest that you're now earning, thankfully, because interest rates are a little bit higher, or if you choose to invest these dollars, we'll talk about in just a second, all of that activity is sheltered from landing on your tax return. And then as you have medical expenses, qualifying medical expenses, you can use your HSA to reimburse yourself or to pay for those medical expenses, and the money comes out tax-free. There isn't anything else like it in the tax code. And so given those immediate benefits, a lot of times, if you have an HSA eligible plan, people will contribute to their HSA however much they think they're going to spend in health expenses for the upcoming year, and then withdraw that money to cover those expenses, and there you have it. However, there is a growing movement of people that are looking at their HSA saying, well, I could do that, and that would be helpful. However, wait a second, the way I understand the rules is I can actually not use this money in the HSA. I can invest it, and yes, that's volatile in the short term. You betcha, absolutely it is. But if it's long-term money and I don't touch it, I let that money rebound and grow, compound interest invested in my HSA, then out there in retirement, this money could be worth a lot more. And yes, I'll have medical expenses out there in retirement that I can use this money. I can withdraw from my HSA to cover. Yep, absolutely you can. But listen, guys, along the way, there's a shoeboxing strategy that along the way, as you do have out-of-pocket medical expenses, instead of using your HSA to pay for those medical expenses, what if you just used your normal cash flow and you paid for it out of pocket instead of using your HSA? You can hold on to those receipts, and I know that sounds terribly boring and frustrating. You can hold on to those receipts and then reimburse yourself tax-free from your HSA out there in the future. That's right, I'm doing this strategy. And let's say, I can't remember what, the middle child just broke his pinky earlier in the fall. And I think the cast and appointment and all that sort of stuff turned out to be, like $600, something like that. And so we paid that out of pocket. And yeah, I've saved that receipt digitally. And out there, 30 years from now, I can draw money out of my HSA to reimburse myself for paying for my middle child's cast back in 2022. That's right, I can do that. Well, why would you do that? Well, because the $600 or so that's in my HSA that I could have pulled out for the cast, if I invest it, that $600 might become $1,200, might become $2,400, 20 years from now. And therefore, I can have that money stay in there and be invested and grow. Yes, I'm taking risk with that. It might not materialize, but if it does grow, I've got more dollars there in that HSA. So this shoeboxing strategy for your retirement, we've been talking to people about for years, and more people are exploring taking advantage of it. If you do that, if you shift your paradigm and your mindset from your HSA being a short-term tool to pay for today's out-of-pocket medical expenses, and you shift it and think, no, this is a retirement tool. This is a retirement savings account that I'm going to stuff money into, and I can draw money out if I want to, but I'm not going to. I'm going to try to pay out of pocket for medical expenses, let that money in my HSA grow for my retirement, and either use it for medical expenses in retirement or to reimburse myself for medical expenses I've paid out along the way. There are significant benefits, not just today that I mentioned with funding the HSA, but significant benefits out there in retirement. The first one is, as you draw money out of that HSA, that means you're not going to need to draw money out of an IRA, 401k, that sort of thing. And as you draw money out of that HSA, if it's not taxable, if it's to reimburse yourself for medical expenses you've already paid out of pocket, or for current, medical expenses in retirement, it's not going to cause more of your Social Security to become taxable. As you draw money out of your pre-tax retirement accounts, typically that means you've got to report that income on your tax return, and the more income you have on your tax return, the more of your Social Security gets added to the taxable portion of your return, subjecting more and more of your Social Security to be taxable. If you don't have a lot of income that lands on your tax return, then less of your Social Security, possibly none of your Social Security, will even land on your return. Your HSA withdrawals, qualifying HSA withdrawals, will not land on your tax return. Therefore, a hidden benefit, but a serious, significant benefit, is that doing this strategy, using your HSA as a retirement account, is going to hopefully, and depending on your situation, allow less of your Social Security to be taxable, more of it to be tax-free. That's one benefit, hidden benefit, that you'll see out there in the future. Second hidden benefit of using your HSA as a retirement account, reimbursing yourself for medical expenses out there in the future, is it will not cause you to be subject to IRMAA, where you have to pay a higher Medicare premium, Medicare Part B, Part D premium, than you otherwise would. Some of you are familiar with this. We've done lots of discussions on how to plan around this. You want to avoid it. Really, guys, you want to avoid IRMAA at all costs, income-related monthly adjustment amount. And that is because your Medicare premium that you pay for Part B and Part D depends on what your adjusted gross income was, modified adjusted gross income was, from 2 tax years ago. And so really, how much income you report on your tax return influences how much you pay for your medical insurance, your Medicare. And if you have to pay more, it doesn't mean you get better insurance. It's the same insurance, you just have to pay more because your income was higher a couple years ago. And so right now for 2023, based on your 2021 tax return, if your modified adjusted gross income for a single individual was above $97,000, you're going to have to pay more. You're going to have to pay more for your Medicare Part B and D. And for joint, if your modified adjusted gross income from 2021 was 194 or higher, then you're going to have to pay more for your IRMAA. Well, HSA withdrawals, qualifying HSA withdrawals, aren't factored in. They don't land on your tax return, so they're not factored into that IRMAA calculation. Therefore, if you've got more and more of your retirement dollars in HSA and you're doing qualified withdrawals in retirement, it's not going to impact your IRMAA, won't cause you to pay more for your Medicare Part B, Part D premiums. And then the third sort of covert or sneaky way in which using your HSA as a retirement vehicle can help you in the future avoid taxes is, again, your HSA qualifying withdrawals or reimbursements won't land on your tax return, and therefore they're not going to push you into a higher tax bracket, meaning if you have qualified dividends or long-term capital gains that land on your tax return, you know that those long-term capital gains and qualified dividends, they're going to be taxed at capital gain rates, which right now, and for my entire career, if your tax bracket has been in the first 2 tiers, so the 0% tax bracket, of course, but 10% or 12%, then your capital gains rate's actually going to be 0% federally. If your tax rate is 22% or higher, up to a certain limit, about near $500,000, then your capital gains rate's going to be 15%. So it's still going to be better than ordinary income, but the point being is your HSA dollars actually won't push you into another tax bracket, into a higher tax bracket. Therefore, it's not going to be part of the equation that pushes you it could cause you to pay more capital gains tax or tax on your qualified dividends. It won't. It will actually help more of those dollars be taxed at 0 or more favorable capital gains rates. So guys, the HSA, you've got to look at it for your own situation. Work with your CFP to see, well, let's look at how the HSA plan affects all 6 areas of my financial life and determine whether it makes sense to do this shoeboxing strategy, whether it makes sense to contribute to the HSA but view it as a retirement vehicle and not touch it in the short term. A normal financial advisor is not going to help you with that. They might give you a couple pointers or whatever, but I don't even know how much value that would be. You've got to work with a CFP that's doing comprehensive financial planning, looking at your retirement plan and your investment plan and your tax plan and your protection plan and your cash flow. Guys, I mean, it requires 5 out of the 6, but then of course your HSA, that's an estate planning vehicle as well. And so it's really all 6 areas of your financial life that need to be considered. So work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.